Hello, this is Guy Grant, your Spring Hill, Florida realtor, coming to you today with some information about additional principal payments on your mortgage. The first thing you would want to do if you're interested in doing this is get yourself an amortization table for your specific mortgage. For the example I'm going to use today, it's going to be a $200,000 mortgage at 6.5% for 30 years, which is just about the going rate today, and the payment would be $1,264.14 a month. The amortization table will go all the way down through all 360 payments. That's 30 years of payments, and show you how much is going to principal, interest, cumulative principal, cumulative interest, and then how much the principal balance is paid down, how much you actually owe. So let's say that you had made your first 12 payments on your house on time, and now you were ready to make an additional $1,200 house payment. Where would that take you? So $1,200, I made a little graph here. $1,200 would take you through the payments 13 through 18. That would be $1,173. So $1,200 would knock 6 payments off of your mortgage. So coming back here, that would take you down to number 18. And then if you made another years worth of payments, that would be like 19 through 30. And then, will that $1,200, or what would it cost to knock another 6 months off of there? And come over here, whoop, and then 31 through 36 would be almost $1,300 to knock 6 payments off. But if you did that twice, you've knocked a whole year off of the mortgage with just 2 extra house payments, which is nice. Now, the farther down you get, you can see the more you pay towards principal, and that's where you want to get, is you want to jump down on this amortization schedule with your additional principal payments as far as you can with each one. And you'll see that even way down here, this is what, 96, so that's 8 years worth of payments. You're still only at $300 going towards principal and still over $900 going towards interest. So the idea is to jump down as fast as you can, especially when you have very little going to principal. One of the things you should know is the break-even point on the amortization schedule is payment 233, and that's going to be the same for every 30-year mortgage. That's your first payment where there's actually more principal, more money going towards principal than there is towards interest. So if you're down here past your 20th year in a mortgage, it probably doesn't make a lot of sense to make extra principal payments. It makes the most sense to do it when you're up here and it's much cheaper. You get more bang for your buck. You jump down farther with each additional principal payment up here than you do farther down on the table. So I hope that's clear. The other question I get is about the mortgage payments. That means that if you get paid every 2 weeks, it might be convenient to get half of your payment taken out of each check, which means you'll be making 26 half payments. Now, 26 half payments is the same as 13 monthly payments, so that's basically 1 extra mortgage payment per year. So that's pretty close to the same example I gave before, that you'll pay it down somewhat faster. Now, there are some disadvantages to this. The advantage is it's easier. Money, you can have it go out of your check. You don't have to worry about it. It gets handled. And if you get paid every 2 weeks and you're on a bi-weekly payment, it probably works out really well. If you switch jobs and you go to a job that only pays you twice a month, like on the 15th and the end of the month, it might not work out so well. So if you do sign up for this, make sure that you can get out of it. And remember that some lenders do charge a fee to enroll for that. It's not going to be a huge fee, but it'll be. And also, the other thing that I've heard is that somehow this will help your credit doing the bi-weekly payments. And unfortunately, this article is from Chase Bank, and it says bi-weekly payments won't enhance your credit score. And the reason being is, if you pay the $600 on the 14th and then on the 28th you pay the other $600, they won't credit your payment as being made until they have the full payment amount. So until that whole $1,200 is in there, that money is just sitting there, and the banks using it for free, basically. But so the last thing I want to tell you is that if you are going to make any additional principal payments, make sure that it is applied to your loan principal. If it's a check, you want to write on the memo additional principal payment. A lot of loan servicers actually have a space that you can fill in and say this is an additional principal payment, because especially if you just make the same payment, like if your payment's $1,200 and you just give them an extra $1,200, what they're going to do is say, all right, you were on payment 60, well, now you're on payment 61, you're just a month ahead, and you'll only get, instead of getting $1,200 and jumping down on the amortization schedule, you'll just be one payment ahead. So if you're going to make additional principal payments, make sure that it gets credited properly. So that's what I wanted to bring you. I hope that's helpful, and if there's anything I can do for you, please let me know.